Well, we welcome Tiara LeTourneau to the Cash Rich Exit podcast. Welcome. Great to
Thanks,
have you.
Colleen. Yeah, I'm delighted to be here.
Today we're going to talk about employee ownership trusts. This is an area I think that needs a lot of light shone on it for Canadian business owners. And you are at the forefront of employee ownership trusts in Canada. So I'm so excited to dive into this conversation.
Yeah, thank you. This is my favorite topic, so I'm glad to be talking about it.
Um, Tara, let's start at the beginning. It's a good place to start, right?
Yeah,
And what exactly is an employee ownership trust?
great. Yeah, so an employee ownership trust is a legal structure, a legal entity that allows the employees to become owners of the company through the trust. So instead of owning shares directly, the trust is going to own the shares of the company, and the employees are going to benefit from the value that company creates. And that's different than direct share ownership in a few ways, but probably the most significant way is that employees don't have to buy those shares. The trust can buy those shares. And so what it means is it's a way to sell your business to the employees, even if the employees don't have the cash to pay for it.
Perfect. And so, how did you get involved in the EOT space?
Yeah, great question. So it was a journey. I didn't start here. My background is in a combination of international development and development finance. And what I did in the finance side was often product development, so developing products or programs for financing. Um, I met the person who's now my business partner right after COVID. So COVID really interrupted the international environment. I
Mhm.
took it as an opportunity to move from overseas back home. And about a year after I got home, I met the person who's now my business partner, Jennifer Owano. And she's a successful exited investor. She's had several exits. Her last company she sold to Rogers. And when she met me, my background in international development and finance structuring, she said, "Wow, you're exactly the kind of profile of person I'd like to ask this question because if you remember during the pandemic, um, frontline workers were really experiencing the pandemic differently than non-frontline workers." And so she said, that really struck her. And she said, "I'd like to make investments into companies in such a way that my investment creates positive financial impact for frontline workers. How do I do that?" And that was an
Wow.
amazing.
Okay, that's a big question, right?
Right? It was a
Yeah.
big question, and it was not, there's not a simple answer to that, right? Like you can't do it in venture capital. It's very hard to do it in private equity. Why? Because whoever owns the capital is the person who benefits from the growth of the company. So we went out, she had sort of been thinking about venture capital because that was what she was familiar with
Mhm.
in her previous fast-growing companies. And I said, "Look, I don't know what it is, but it's not venture capital." So we went out looking for models that already existed and also we're open to the idea of creating a model that didn't exist if that's what it came to. And that was really the formation of Rewrite Capital. At the time we started with an impact investing lens. And what we discovered was that in the United States, they have had a legislation for 50 years with a really robust and healthy ecosystem of trust-based ownership that delivers amazing results for the employees. And so it is possible to come in and make an investment. Usually it's a debt investment in the US for tax reasons, but you can do it as an equity investment too, alongside a company that's transitioning to an employee ownership model. And the benefits of that investment, yes, flow to the investor, but they also flow to frontline workers. And that was really exciting for us. We were like, we looked at a lot of different things, and this one just, it was great for the businesses, it was great for the sellers, it was great for the investors, it was great for the employees. It just ticked all the boxes. And so as we built out, towards building a portfolio in the US, we're both Canadians, and so we came back to Canada. We went to some top lawyers here and said, "Could we do this in the Canadian landscape?" And they said, "You can't. There just wasn't a way. Most of our trusts have a 21-year horizon on them, and then there's a taxable event. There are companies that have tried to innovate in this space, like Friesens Press in Altona, Manitoba, who, without having an EOT legislation, really tried to create something very similar to it, but it's very difficult, very challenging to manage. And so while we were looking at building a US portfolio, we also started lobbying the federal government to do this. And what we discovered was we were not the only ones lobbying for this. Social capital partners had been doing that actively for a year before us. They were also active in the trust-based employee ownership space in the US. And then also Friesens Press was getting involved. And before we knew it, everybody came together in a really amazing way, led by the folks at Social Capital Partners, to form the Canadian Employee Ownership Coalition to fight for good legislation. And we were deeply supported by the US and the UK because the United Kingdom, so the US has had their trust-based model for 50 years. The United Kingdom has had theirs in place for 10 years. And so with support from both of those countries, we were able to make a very strong case for new legislation and got it in a very, very fast time. And so that's the journey, sort of how we ended up coming to build legislation. And I just want to put a plug in here because with the support from the US and the UK, Canada, I believe, has the best legislation in the world now because we were able to learn from both of those economies. The United States has a model that is really powerful at wealth redistribution, and the UK has a model that's very light and flexible and easy to implement. So we said we want both. We want both of those things, and we want to not take the things that have been problematic. So I feel like the international community now is really looking at Canadian EOTs and saying, this is the best model out there right now. So we actually have an amazing option that people can use. People just don't know much about it yet.
Right. And I'm just learning about it. And it is one of those scenarios where sometimes it's best not to be first out the gate because of all of the things you just described, because you're able to take the best practices and combine them together to make an excellent practice.
Yes.
Your role is CEO at Rewrite Capital Advisors. Okay. And so what is the role of Rewrite Capital Advisors in this space now that the legislation is here and companies can be taking advantage of it?
Yeah, that's a great question. So to do a transaction to an EOT is still a lot like doing a normal mid-market transaction. You are still selling your company, and that's something that maybe people don't realize at first. There's a few things, I think people think when they are doing an EOT or if it's employee owned that it's a worker cooperative where you're selling to all your employees and all your employees sit at the board and everybody has a vote. That's not what an EOT is. An EOT is a very traditional structure. Employees don't sit at the board, they don't vote at the board. They do have a representative that sits as a trustee of the trust. But to do this, you still have to prove an arm's length transaction. And the reason why is if you imagine a scenario where you don't have to do that, then an owner can set kind of any price they want and force the sale to the employees, and that's what the employees are paying. So to prevent that, you have to prove an arm's length transaction. And that means that there's often a bank financing involved, there is due diligence. It's like a proper M&A transaction, which is complex, right? And so Rewrite Capital has we stand in the spot that most people do. So we're not an impact investor in Canada. When we realized the Canadian market was going to get this legislation, we said, what is the biggest need? And it isn't finance from an investment standpoint because it's so new. It's actually transaction support. And that's what we do. We support with the transaction. So we act as an M&A advisor. We assist with the due diligence process. We do the financial forecasting. We help people design what the right structure looks like. But then we also do something that most M&A firms don't do, which is a lot of change management skills, because what we're changing is how your company is governed and also how the benefits are distributed. And that's going to have a cultural impact. It's usually wildly positive and turns into increased productivity, increased profitability, higher growth rates, longer retention rates. But it is important to do it well because
those are all the things that we need in Canada right now.
Exactly. Yeah, exactly. So I think we do, unlike most M&A firms, which will just help you structure a transaction and get you to the sale line and out of the way, We also do design and culture work. So we call it design and implementation. We help you design a governance structure that's right for your company and your culture. We help you design the benefits that are going to reward employees in a way that is going to drive your goals forward. So it's not in opposition to any of your company goals. And we also help you to roll that information out to everybody so people know what they have and what they don't have, that it's not a worker cooperative. You're not voting at the board level. That's not what this kind of ownership is. This is an ownership that's about the value created by the company and how you benefit from it.
All right. Okay. So that I think gives a really good broad explanation of what it is, what it isn't. If we were to kind of dive down into some of the practical side of things, okay. Um, who would like what types of companies do you think this is best suited for based on how you've been involved in creating it as a facility? What companies would best be suited to go through this type of M&A transaction to convert to an EOT?
Yeah, that's a great question. So really, this is a mid-market transaction. So if you're like a tiny little shop, 5, 10 people, this probably isn't the best solution for you. And there's two reasons why I would say that. One is that these transactions are mid-market transactions with a lot of customization and they're expensive. But the second, probably more important, is if you have like 8 people and you need a formal board and a trustee or a set of trustees, then it's also a lot of governance for a pretty small team. So there are other, employee ownership mechanisms for smaller companies. We like to say if you're sort of around 2 million EBITDA and up, if you have 25 employees or more, then that's where it starts to be a really good fit. And there isn't really an upward limit on this because if you think about, again, I'm going to refer to like a worker cooperative or even an ESOP where many people hold shares directly. They're all having negotiations at the board. In an EOT, they're not. So you can have thousands of employees. If you look down in the States, you've got Publix with over 100,000 employees. You've got Recology, a large recycling, and they have over 70,000 employees. This is a very traditional business structure that works super well for super large companies. You don't have to be that big. So I would say 25 employees and up, 2 million EBITDA and over is kind of sort of the category. And then I would say there's no one industry that this is for. If you have really high capital expenditures, if you're always putting your cash into renewing equipment or machinery, it can be tough because this is a leveraged transaction. But there are sort of two general buckets of types of companies. One is what I would call light manufacturing. And those companies tend to be companies that are multi-generational. They've been in the family. It's passed down once, maybe twice, and there's no more kids to pass it down to. Those people have often worked with their teams for their whole life.
Mhm.
They really care about their people and they care about the legacy of the business, and they should. They've put a lifetime of work into that. And so the idea of selling it to private equity or a foreign buyer or something like that, there's just the sense of like it's almost a trauma,
Yeah.
to have worked with all these people and then just to sell it to the highest bidder feels really uncomfortable. And so an EOT is a great fit for those companies because you protect the legacy, you reward your teams financially, and the business lives on, right?
And
So
it
that's
typically is community based,
think
yeah.
about the Fraser Valley in British Columbia, or you think about, Mississauga, where you have a lot of sort of these light manufacturing companies. There's just like a lot of intergenerational care that's gone into building them into what they are. And it's very difficult to let those go. So if you have a family-run business, this is often a really great option if you don't have a next generation. And on the other side, you have sort of service businesses where I like to say, your people are your competitive advantage. Think architects, engineers,
Mhm.
designers. Like if what you need to do is protect the culture because your people are the culture. They're also your secret sauce in the marketplace.
Mhm.
And that's often slightly younger owners who maybe aren't needing to exit right away. But this is all about protecting the values, the culture that they've developed, and it's often very driven by the senior management too, who wants to buy in, but maybe the company is too expensive for them to afford, right? So those are sort of two really classic industry areas that we see EOTs happening in.
Okay. So then we know what it looks like, what it's not, some typical industries or companies that might fit that model. Okay, let's say you're one of those companies and you want to explore this,
Mhm.
what is the first step? What
Great
was the first
question.
step?
Yeah, what's the first step? Well, I mean, I would almost say like the preface before that is to realize that equity exits are not the only way to exit a business. And that sort of underlines all of this, right? Is like we're really passionate, maybe have more choices than you've been told. You've been told that you need to sell your business, you should sell it to the highest bidder. That might be private equity, it might be a strategic acquirer. A lot of those aren't even Canadian companies if you're a mid-sized company. So the first thing I think to consider whether you do an EOT or something else is that equity is not the only way. Somebody doesn't have to show up on day one with a pile of cash in order for you to sell your business. You can also do this as a debt exit. And that's really what an EOT is. So, an EOT is really instead of selling and on day one, your employees show up with the whole cash value of the business, you are basically creating an IOU. And I want to drive this home because sometimes people come to me and they go, why would anybody give their business away to their employees? Well, it's not a gift. You're still selling it, right? It's still a sale. You're still
Wow,
going to get
you're
the full price.
altruistic.
Yeah, right? Exactly. Yeah. I'm like, no, 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 this is a sale. And you're going to get a fair market value. So it won't be done through bids, competitive bids. It'll be done through like a business valuator who will assess the business and come up with a market value of what your business is worth. And then the trust is going to pay you for that. But instead of paying you all today with equity, you're going to create a debt structure that involves bank debt and it involves some seller financing. So the bank will show up with some amount of money for you on day one, whatever the company can in a healthy way pay back. And then you'll have an IOU for the remaining amount. So you get paid out in two waves, let's say. Some from the bank on day one, and then some later when you get the sort of second payment for the value. So
Which means that the business needs to continue to grow, needs to continue to be profitable in order to be able to pay the the bank, but also to pay back the seller take back loan, right? Like,
yes, exactly. And so, sometimes people come to us and I think they might be surprised for us. They say like, if I want to sell to my employees in a trust 2 years from now, what should I be doing? And I think sometimes they're surprised when I say, go maximize your valuation because I still want the seller to get the best possible value for the company
mhm.
that they can, right? So this isn't an either or. This isn't like feel good or make money. This is both. You're going to make the most value that you can. And you're also going to leave the business in the hands of your employees who know it best and understand it and can protect that culture. So the steps to doing that, to doing a transaction, are very similar to if you were selling to an outside buyer, right? So many of the same things. You want to get your valuation in order. You want to clean up your organization to get ready for the tax benefits. So like looking at the structure, making sure how you're holding it is tax efficient for you at the transaction time. You want to put your filing in order because there's going to be due diligence and it's like really a lot of work. People don't realize how much work there is in the due diligence process. If you have any, debt, you may want to pay that down. If you're hoarding a bunch of cash on your company, you need to clean that up as well. But where it might be different between selling to an outside buyer and selling to your employees is you also need to make sure that your management team has the bench strength to take it over from you. So sometimes we come across sellers who really own the sales function and their team doesn't do that. Or they really have, no one else has really got that sort of like decision-making leadership power. So you want to be thinking about not just like how do I get my company ready for the finance side of the exit, but culturally,
The
does
people
your team have the
team
ability to do it?
talent.
Yeah, exactly. And that's maybe one of the differences because if you sell it to somebody else, they're going to run it. But if you sell it to your team, can your team run it without you? And one of the nice things about an EOT is you don't have to leave the day after you sell. You can continue to be involved for a period of years if your team needs that development. So just because they're not ready today doesn't mean you can't make that sale today, right? It is in a sense, it's a partnership of turning responsibility over in a graduated way to your team. But you do want to think about what they need to be able to get there to run it without you.
What about, so there's your organization, you're doing this work with business owners. There are some others across Canada. We're going to focus on your team right now.
Sure.
Um, how does someone get in touch with your team? And are you working across Canada or are you, because you're located in BC, are you like, tell us a little bit about that.
Yeah, let me tell you a little bit about the team at Rewrite then.
Mhm.
So, if you want to learn more about us or about EOTs in general, we've really tried to set up our website to be a place where you can go get information about this because there's not a lot. The nice thing about what the government did is they created a fantastic piece of legislation, but because they did it from a group of passionate citizens asking them to, they didn't really publish it or broadcast it or give much information about it. So you can visit our website. It's www.rewrite.capital. That's it. And we've got all kinds of resources there. What our team does is we work all across Canada. We only work on EOTs. So whereas you might have other advisors, lawyers, accountants, et cetera, who are familiar with this is all we do day in and day out. We don't do any other kind of transactions. And we're really trying to bring that expertise from other countries, from our experience to the Canadian market. So you're already working with best practices for these transactions. And our team really does 4 steps to help people to get through this. The first is we'll do a feasibility study with you. So that feasibility study is really going to be your roadmap for what's the best way to do this transaction. Unlike a normal market transaction, like if you're selling your company, people just maximize for one thing, and that is seller price, really, right? What is the price? But here we need to make it work for everybody. It has to work for the seller, has to work for the company, has to work for the employees and the bank. So there's not just one way through, there are multiple ways, and we come up with what are the ways that we think would be best to meet your objectives. That's at the road mapping stage.
Mhm.
Once companies have decided they want to do a transaction, then we help them through the transaction in really 3 distinct ways. The first is we do the design of your governance structure, design of your board, your trustees, how they get selected, design of your benefits, how your employees are going to benefit from it and what the conditions are around that. We do the transaction work for you, so we'll help you to find EOT expert lawyers, accountants, trustees, the banks that are needed to do the transaction who already understand how EOTs work. And the last part is the implementation. So we help your team get ready for launch day. We help with the communications. We help with the training so that everyone is ready to go when it's up and running. And that sets the groundwork for success so that people on the other side of this transaction, you've given it to the employees through an EOT, you've sold it to them, and now they know what to do with it. They know how to make it super successful. And so that's really the steps that we take.
Okay. And to get in touch with you, they go through the website. There's some type of intake document, I'm gonna guess, and
There
then
is.
an
Yeah.
outreach from there.
Yep, there's a contact us page and you can fill in the information and our team's super responsive. We also have a newsletter. So if you're like, oh yeah, this EOT stuff, this is ringing a bell, but I'm not at that moment. We have a newsletter. We don't send newsletters very often. I would say maybe 4 times a year. But it will keep you up to date on the latest news in the world of EOTs, like what's happening in Canada, which companies are going through it, and have completed that kind of stuff. So it's an opportunity for people to sort of stay in touch with the environment.
Well, I I think it's fascinating, and of course, one of the things that got my attention was the tax perspective. I mean, one of the things that I hear all the time from business owners is, how do I keep more of what I've grown in my own pocket? I mean, there are so many advantages, but it is one that I think we should put a little bit of shine a little bit of a light on here. So, being that you were involved in the legislation, maybe you could share what that looks like with our
Yeah,
audience
actually, in a
here.
way, I buried the lead, didn't I, Colleen?
You focused on the really the things that are really impactful for the human beings, and I think we don't do enough of that. But sure, you buried the lead.
All right, well, here's the buried lead. It's that if you sell your company to an employee ownership trust, then you do not pay a dime of taxes on the first $10 million value of the sale. So, and that is called an EOT, capital gains tax exemption. So this actually stacks with people's lifetime capital gains tax exemptions. So let's say that you have a husband-wife owner of a business and they sell it to an EOT. They can get $10 million exemption for the EOT sale. plus each of them taking 1.25 million. So then you're up to, at an individual level, person can have 1.25, or if you have a couple owning a business, they're at $12.5 million, no taxes on that. And there are some hoops to jump through here. But ultimately, the reason why this was done, and this is not new. This is actually modeled off the US and the UK. And I would say Canada didn't go far enough. And we are going to argue for it to be higher than $10 million. And I'll tell you why in a moment. But the idea here is the government is trying to encourage you to do this. Why? Because there is a very powerful set of consequences when businesses become EOTs. A bunch of things happen. First of all, it could not be more important right now. Canadian businesses stay Canadian, right? Who's the number one buyer of mid-sized businesses other like outside of Canada? It's the US. And the proportion of US purchases of mid-sized companies in Canada has just been going up and up and up. And with a weakening Canadian dollar and a strengthening US dollar, there's going to be even more of that. So the government said, okay, this is a way to keep Canadian businesses Canadian. It's also a way of redistributing wealth without taking it away from anyone, right? This is a structure that allows business owners to get fully paid for what they created, but allows the next owner to be people who maybe don't have the cash to buy it. So everybody's getting rewarded here, but the wealth is also being redistributed, which is difficult to do. And the third thing is that when you redistribute wealth like that, where does it go? It goes right back into the community. So it has a powerful economic development function in the community. And for all of those reasons, the government said, we believe that there should be a capital gains tax attached to this. It also offsets the fact that you don't get all of your cash on day one, right? You have to wait some that in seller financing. So you keep more in your pocket. But what I should say about this is we think that we can go higher than 10. And the reason why we think that is in the United States, there's not an exemption, there's a deferral, but it's for the full amount of the transaction. And in the UK, there is an exemption, not a deferral, for the full amount of the transaction. So if you did a transaction at $500 million, that was the value of the company when you sold it to the EOT, then you would not pay a dime of taxes on that. And so Canada really
In the UK.
Yeah, that's in the UK, UK. And we're going to argue for that as an industry association. We're going to argue for those kind of benefits here in Canada as well. Why? Because when you only have a $10 million capital gains tax exemption, then you're not really incentivizing the largest ones, which have the most employees, right? At a certain point, that amount becomes too small for them to make it a consideration. But for most business owners out there, this is a very, very powerful benefit, right? I wouldn't say this is the reason why somebody does an EOT transaction, but it certainly is a benefit for those who do, and we're really pleased to have it.
I think, the bearing the lead part, it's a reason that will get people's attention, though, who haven't been aware that this was an option, to actually do that due diligence to say, this is interesting. How might I benefit from it? Because what's in it for me? Even the most altruistic person, still there's this what's in it for me scenario, right? That we want to consider. So I think that's so important. Yeah, it's absolutely fascinating. I've been enjoying learning more and more about EOTs, and I suspect that we will have you back on as there are more successful EOT transactions happening in Canada. So I hope you'll come back and join us and share those success stories so that we can
Absolutely delighted.
Let the Self-Made Nation know what's really happening. Okay, so there's your website. How else could people get in touch with you if they wanted to?
They can email me. My email is Tiara, Tiara, at rewrite.capital. So, and I should also say that there's an industry association called Employee Ownership Canada. I sit as the board chair at the moment, and it was an amalgamation of two, a smaller organization, grassroots organization in the employee ownership space, and the Canadian Employee Ownership Coalition that fought for and won legislation. They merged last year, and they've built a whole website now. It's employee-ownership.ca, and it's full of resources for learning about EOTs, including webinars that we've done to help people break down and understand it. So I highly recommend, if you're trying to get sort of up to speed on what are the benefits for sellers, what are the benefits for your employees, what does a governance structure look like? All that is on there, and it's really easy to digest. So definitely feel free to take a look there. But yeah, people are welcome to reach out to me at any time to talk about their own companies. Highly recommend that you kind of just go check out some of the resources on EOTs first. Sometimes people don't realize how good of a fit it could be.
Hmm.
And I might also say sometimes people will hear from their expert advisors, lawyers, accountants, bankers that this is a terrible idea and you shouldn't do it. Um, and I think that what people are reacting there to is the idea that this is new and therefore risky. But I want to push back on that and say that, first of all, they're new in Canada, but they are not new.
Hmm.
We have 50 years experience with them in the US. But also to say that risk is like the potential for loss. And uncertainty is just not knowing something. And we often confuse those because they feel the same emotionally. But these are actually very low risk. Banks don't see it as risky, so I don't think other people should either.
Hmm.
Just but it's certainly okay to reach out and talk to the experts in this space if you just want to get like a first brush look at how does this fit for our company.
Well, I've had lots of conversations, and as I am just learning about it myself, I've not been able to do a very good job of translating what it is, but all of the things that you're describing are all I'll say the myths that are out there about, what an EOT is. So all the more happy to have you on the podcast and be able to go, no, 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 you need to go listen to this discussion that I had with Tiara.
Yes.
I like to wrap up these little chats that we record, asking for one piece of fun, frank advice.
One
So,
one piece
yeah,
of fun frank advice.
what would you have to offer, Tiara?
I would say consider if financing were not a constraint, if the price were not a constraint, who would you want to sell your business to, and how would you want to protect your legacy? Because sometimes I feel like we go down this road of, hey, and who you wish could own that business, there may be more avenues to get there than you realize. So before you take the tried and tested path that everybody walks down all the time, think about what you most want to protect before you have those conversations. Because if you start by saying, this is really where I want it to go and this is how I want to protect it, you can find people who work with you creatively to get you there. And I think on the other side of a sale, not only do you have the financial value, but you now have the comfort. I think that's the what we all really want from a business sale is not just the wealth, but the comfort, right? And so I'd say start there.
Awesome. Thank you so much for investing some time with us today, Tiara. It's been more enlightening.
Thanks, Colleen. It's been such a pleasure.